In today's video, we're looking at a powerful interview with Warren Buffett, chairman of Berkshire Hathaway, speaking with CNBC's Becky Quick at the 2026 Berkshire Hathaway annual meeting. Buffett shares a bold take on today's market, saying that, when the market crashes, that's when you act. He says the current market feels more like a casino than a place for real investing. I'm going to show you the interview, then break down exactly what he means and give you my own reaction to his insights. After that, I'll walk you through two undervalued growth stocks that could be strong opportunities in this kind of market. Let's hear what Warren Buffett has to say.
We are sitting down right now with Warren Buffett, the chairman of Berkshire Hathaway, who for the first time in 60 years has been watching all of this from the audience instead of being on stage. And, you know, last year at this time, Warren, you surprised everyone with the announcement that you were stepping down as CEO. Fast forward a year, and here we are. What do you think?
Well, I think it's all working. It's all working. It isn't our ideal surrounding area or environment, I should say, in terms of deploying cash for Berkshire. Okay. But in terms of how we got the right management, we got the right arrangement, and you know, we can pick our spots, and nobody can tell us what to do exactly, and so sometimes we're doing nothing, but other times we get quite active. I mean,
you know, Ajit spent some time on the stage today talking about how one of his keys is to do nothing when it comes to insurance, when it comes to writing insurance, which is the same thing that you have always talked about with whether to invest or not.
Yeah, the world is full of people that are offering you things to do, and then the question is to find one that you know makes sense. And there may be 20 out there that make sense that you don't understand, and you just leave them alone.
You said that the world or the surrounding environment is not ideal, and I guess that points to the idea that there's almost $400 billion in cash on hand, although Greg took some pains to show it's really more like $380 billion in cash on hand. Yeah. But there's a lot of cash on hand, and you're still active in managing the portfolio, too, and looking at stocks. You're looking around, and you don't see a lot that you want to invest in.
No. Well, then we don't do anything. I mean, we've been of the 60 years I've been in the business, you know, there's probably 5 of them have been really juicy, you know. And I think it was Tom Watson Sr. of IBM that said, they asked him the reason why IBM had been so successful or something like that. And he said, I'm smart at spots, and I stay around those spots. And that's the whole thing. And IBM was in 3 different businesses, including time clocks and a couple of, and 2 of the 3 turned out to be no good, but so they just focused on the one.
What is it when you look around that it's just prices are too high at this point? I would imagine there are, Greg said this from the stage too, there are businesses that you like, just not these prices.
And I would say I understand fewer of the businesses as a percentage of the whole than I did 10 years ago. I have not learned new industries for some years, you know, and so I don't kid myself on that. I'm not going to learn them. I'm not going to have an edge on, you know, a whole bunch of younger people that have actually grown up with them, used the product, seen things, but well, as I mentioned, you know, you don't have to understand too many if they're like Apple.
But looking around, let's just get some macro thoughts on this, because I don't know that this is something that Greg is going to comment on per se. Just looking at the macro stock market environment, what does this feel like to you? Does it feel expensive? Does it feel like there are opportunities in some places?
Well, it feels like, you know, I've compared the markets to a church with a casino attached, and people can move between the church and casino, and I would say there are more people in the church and more people in the casino, but the casino's gotten very attractive to people. You know, if you're buying one-day options or selling them, I mean, that is That's not investing. It's not speculating. It's gambling. Just totally. There's nobody that can explain why they're buying an option for one day, unless they maybe the fellow that made the $400 and some thousand from knowing when we were going into Venezuela could do it. But I mean, that's really, and the quantity of those things is just incredible. So we've never had people in a more gambling mood than now. But that doesn't mean that investing is terrible. It does mean that that prices for an awful lot of things will look very silly. I mean, they had a squeeze and Avis of all things. Well, Avis has been around for 50 years, but just this past week, we have lots more regulation and everything now, but people spend their time figuring out how to get around the rules rather than follow the rules. That's just a challenge.
The type of investor you are, though, is you laid it out yourself. In the 60 years you've been doing this in the business, you've had maybe 5 juicy years. I guess that means you're always looking for the next juicy year. What do you think it would take to make a juicy year or a juicy opportunity for you?
It's a phone call, and in some cases, but we bought a business last year. It wasn't big enough to be meaningful, but we got a letter.
Bell Labs?
Yeah, Bell Labs. And sometimes there's more zeros attached to them than others, and we're big enough to handle anything, and we can make decisions faster than anybody, and our word is good. There's an awful lot of people that they're in the business of reselling something, or and it's a lot better if you're a good salesperson. There's no reason to be selling vacuum cleaners, or as well sell stock. You'll make way more money. It's where the money is, and there's more money around than ever.
But the best opportunities have probably come when the macro environment leads to panic.
That's the most likely.
Right.
Well, the most likely time to buy things is when nobody else will answer their phones. Everybody else talks about their wonderful trading departments and everything. Just try them out. Sometime when markets are collapsing, they don't answer the phones.
Right.
And if they do, the bids are subject, and the offers are subject, and the spread is wide, and they'll use the information they get from you about what you want to do to go out and kill you some other way. I mean, it's really like going through a slaughterhouse. I mean, you don't feel like eating hot dogs for a while.
I guess what I'm trying to get at is, do you see the circumstances building up anywhere that could lead to a time like that again? Is any sort of panic in the market?
Sure.
Where do you see them?
Well, if you saw them, they wouldn't happen.
Okay.
I mean, you've got all kind of, you don't worry about what people are talking about can happen. It's something that comes out of the blue, but something will come out of the blue.
Yeah.
I mean, a nuclear bomb can come out of the blue.
Well, let's knock on wood on that.
It doesn't do any good to knock on wood. That's the point.
Yeah.
It was the Archduke getting shot, in 1914 or something like that for World War I. And it's just take everything in life, and if it's something people are talking about and thinking about, it's not going to happen. Yeah. But there are things that can happen out of the blue, and actually that's particularly true, to use that phraseology now, because the things that can come out of the sky, we don't know what can happen tomorrow. I don't like to talk that way to people, whether it's you or anybody else. I mean, because, whether it does you a lot of good to worry about that, I don't think it does do any good to worry about it. I think it's good to be cognizant of it, but the worrying about it is terrible. I don't like to even cause that belief with people. I don't like to go around tell them the end is coming, or something like that.
A friend told me yesterday he's recently started using the phrase, I don't fret, I don't worry, and that's probably a good way to go about life. But let's talk about some of the issues that are out there right now. Inflation is up. That's an issue. So how does Berkshire handle that with its businesses?
Well, we can't handle runaway inflation except not to be there in the way of it. And if you look at the number of countries that have had runaway inflation since World War II, in my lifetime, it's very large. Once you create that, it becomes a different world. In Germany, obviously experienced it after World War I, but there are dozens and dozens of countries that have experienced it. And of course, you have countries that have gone bankrupt like 6 or 7 times. I mean, it's just amazing what people do in financial markets.
What about the inflation that we're dealing with right now, which is, not excessive? It's north of 3% at this point, but we're not even back at the levels we were during COVID. We're looking at 8 to 9%. So what about just higher energy prices, how that works through the line, and how you handle it?
Well, it came close before Volcker. I mean, it was cash is trash, and people were losing faith in the currency, and they felt they could borrow and 12% to earn 6% on farming or something like that, and they had huge farmers in this state, Nebraska, collapse because they bought beyond the earning power. Their paid interest rates beyond the earning power, just because they felt that the dollar was going to disappear and the land wouldn't disappear, and it's tragic for many people, and if you're the best doctor in town or the best lawyer in town, you'll always make money under any situation. The best TV personality. I mean, but what not having faith in the money does to a country, it turns it into something else.
Yeah.
And I've always hoped that the U.S. never does it, but we are not immune from it happening. We have a lot of control over whether rates may go up a half a point or down a half a point, but we may have less control over whether they go up 50 points.
You've long been a supporter of Jay Powell's.
Exactly.
He had his last FOMC meeting as chairman just this last week. He did say that he's going to be sticking around, staying on the Fed, staying in that position for the foreseeable future, in part because of the threats that he's faced.
I'll feel better when he's there than when he's not. I mean, I felt better when Volcker was there. But economists aren't the best at this sort of thing. Read any old economics book from 1950 or 1970 that was that Paul Samuelson, who was a terrific guy and smart as hell, he had the standard textbook for 25 years, and if you looked up, zero interest rates, and year after year after year, it was a 900-page book, and there wasn't an entry for it. I mean, it was the most important economic development. I mean, in terms of the impact it would have and everything during the lifetime of the students reading it. But it's what you don't think of that does all the damage.
Yeah. Let's talk a little bit about CEOs in some of the Berkshire holdings. You mentioned Apple's Tim Cook. and just the phenomenal job you think he's done.
Incredible.
He's not the only one of your major holding CEOs who stepped down. James Quincy recently stepped down from Coca-Cola, too. And we just spoke with Vicky Holub, who announced that she is retiring and stepping down from that position at Occidental. Part of what Greg's talked about is how stable that portfolio is. And these holdings are companies that he knows and managers that he knows. There's going to be some new managers in some of those major holdings coming in. Is that a problem?
Well, it was certainly a problem with Coca-Cola there for a good many years when I was around the company. I mean, yeah, sure, it's and you have the most problems with a really good company because it'll continue. I mean, if you're selling some product that people are buying every day, you can make the wrong decision for a long time. But that's one of the problems with investing. Tim Cook, I felt was very, very good from the start, and most of our managers are very good at the smaller problems. They can't anticipate the overwhelming problems. That's my job, or now Greg's job.
Do you feel good about those holdings still? Have you met any of the new managers of those businesses?
I haven't met the old managers.
Of the new businesses, of the new CEOs that are coming in. Tim Cook's replacement, Enrique at Coca-Cola.
I certainly met the people at Bell Labs that we did. And obviously I met Vicky. We made the deal.
Right.
And so I enjoy meeting the people. But you can make mistakes with people. I mean, look at the divorce rate.
Right.
That's more important than whether you got the right CEO or anything else.
Right.
And now you've got years of trial. I mean, back when I was young, I mean, you had to make the decision. Or you didn't have to make a decision, but a good many people made the decision when they were 20 or 21. Now,
to get married.
Yeah, they got married. Yeah. And now they spend 5 years and they still make the same mistakes.
So you think we're getting worse at our judgment?
Well, I don't know. Maybe the people behave differently before the marriage than after. Who knows exactly? Yeah. I would say that almost everybody feels either their marriage is better or worse than they anticipated a month after they were married. But I don't know which.
Warren, let's talk a little bit about deepfakes, because the deepfake Warren that popped up early in this session was pretty good. They had somebody standing up. Greg was joking about it, but the first question went to a guy from Warren up in the rafters who lives in Omaha. You've been concerned about some of these AI deepfakes and what that means for the world. Yeah,
I would be concerned if everybody was. Well, actually, the worst thing would be to have a really good imitator of any president that came along. I mean, just imagine. Well, yeah, we had that famous thing before, way back in New Jersey, where the Martians coming and everything like that.
Oh, War of the Worlds with Orson Welles.
What you can do, well, if you convince people to lend you money for it, you shouldn't be borrowing it. I mean, it's scary. And it's particularly scary when you have 9 countries or so with the nuclear weapons and people working on something even more later. We haven't dealt with this. We don't know what's going to happen.
Yeah. Let's circle back to Berkshire and the Berkshire of today. I think I was speaking with you yesterday or the day before, and we were talking a little bit about Greg Abel. And what a nice guy he is. And
He's a terrific guy.
You said something interesting to me, though, about how you picked him, and it wasn't because he was a nice guy. Why did you pick him?
Well, he's very, very, very smart about businesses. Incidentally, he's getting his he's getting his American citizenship here very soon, and he was going over with me all the things he had to learn about. And I've actually spent a little time in the past with groups of individuals. Of course, my wife did it too, became an American citizen. And the things they have to learn about the Constitution and all this, and they're usually so proud when they become American citizens. And I think I detected in Greg even. I mean, you know, as successful he's been and everything else. I mean, he is. It means something to him to become an American citizen, and you know, he sits there with his young son, you know, and the son knows more about some of the answers to the questions, you know, that he may get asked or something about becoming a citizen. It's really interesting. And where else does that happen in the world? I mean, what people, you know, that America's special, and it's a miracle what America's accomplished. I mean, it's just an absolute miracle, and yet the miracle, the division of the output and everything is about as inequitable as you could come up with, while at the same time it's got these great attractions. There is some secret sauce. I've never been able to define it precisely, but when you run a country for 200 and some years and people want to come here every year, I mean, there's really something about it. And what Greg Abel is very, you know, is looking forward to becoming an American citizen. That means something to him. And you can't buy that any place or package it, or, you know, it won't work for a Madison Avenue approach, you know, and, you know, be an American or something like that. But that feeling just goes. In my 95 years, I've seen it, you know, it's time after time. So I felt good when Greg just volunteered that in the last day or two to me, that he was up there for his final exams here pretty soon on becoming a citizen.
I didn't realize he wasn't a dual citizen already. I knew he was Canadian, but I thought he had dual citizenship.
He doesn't have a full, whatever the complete citizenship requirement is. And you can say, why does he care? I mean, he's gotten along fine without it here and everything. He still wants to be a citizen.
Yeah. 250 years, we're celebrating our 250th anniversary. You pointed out that you've been around for 95 of them. You think we have the special sauce that will continue in this country, or what do we need to do to preserve that and make sure that it does continue?
We've got a special sauce. There's a secret sauce. It's such a good secret that I don't know what exactly it is, but I do know this, that anybody that has a choice would choose to be born in America. I mean, you know, you can pick some very small little country, they're very happy that they're, but is there any other country that everybody's, for a couple hundred years, has wanted to emigrate to? I mean, and it attracted some terrible people, you know, too. But it worked, and they had the mafias from the different groups. Not just the Italian mafia, but all. I mean, it wasn't that they were all. We had some system for picking out the wonderful people from some other countries, but it has worked. But it's worked. The extremes to which it works don't seem to belong to that kind of a society. I mean, if you were drawing up dreams for the ideal society, and you would have this kind of GDP per capita and everything, you wouldn't design the inheritance laws. You wouldn't. I mean, you just do all kinds of things differently, but somehow it's worked. But that doesn't mean that we can't do better. I mean, at all.
You know, Warren, there are thousands of people, shareholders and partners of yours for decades in some cases, who are sitting out in this arena right now. And I just wonder if there's a message you'd like to give to them. Those who've been following you for years and who've been partners of yours for years.
The number one rule I give them is just not give them the golden rule. Doing others. I'm not a religious guy, but I mean, nobody said it any better in a couple thousand years than that. which may be why it's lasted to a certain degree too. I mean, more people are reading a 2,000-year-old book about how to behave than anything that anybody's coming up with lately. Now, it's got a lot of, particularly the Old Testament, it's got different kinds of stories to some extent. But if the whole world lived by the golden rule, it would be such a more wonderful society.
Do unto others as you'd have them do unto you.
Yeah, and that's true for everything from parenthood to being a boss to being just everything in life. And it doesn't cost you anything. In fact, it's reflected in better behavior toward you. So, I mean, it's a very selfish sort of thing in one sense. But I've never seen anybody that's unhappy that behaves that way. And I've seen a lot of people in a lot of different kinds of situations.
What really stood out to me right away is the tone. Buffett is no longer the CEO of Berkshire Hathaway, and yet he sounds completely at peace with that. He opens by saying, "It's all working," and that might sound simple, but if you really think about it, that's a huge statement. This is a man who spent 6 decades building one of the greatest investing machines in history, and now he's basically saying the system can run without him. That tells you everything about how much he values structure, discipline, and especially people. But then he quickly pivots into something more interesting. He admits the environment right now is not ideal for deploying capital, and this is where I think a lot of people miss the point. When Buffett says it's not ideal, he's not complaining, he's actually signaling discipline. Most investors feel pressure to always be doing something. Buffett is telling you the exact opposite. Sometimes doing nothing is the smartest move. And honestly, I agree with that more than ever in today's market. We're in a time where everyone feels like they need to chase the next hot stock, the next AI play, the next breakout trade, but Buffett is sitting there with hundreds of billions in cash and basically saying, if I don't see it, I don't touch it. That level of patience is rare, and it's probably one of the biggest reasons he's been so successful. He even reinforces that idea when he talks about how in 60 years, only about 5 years were truly juicy. Think about that. 5 real opportunities in 6 decades. That completely destroys the idea that you need constant action to win in the market. It's more about waiting for the right pitch and then swinging hard when it comes. He brings up Thomas J. Watson Sr. from IBM talking about staying around your spots. And to me, that's one of the most underrated investing principles. You don't need to understand everything, you just need to deeply understand a few things. Buffett even admits he understands fewer businesses today than he did 10 years ago. That level of honesty is refreshing, especially in a world where everyone pretends to be an expert on everything. Then the conversation shifts into the broader market, and this is where Buffett drops one of his classic analogies. He says the market is like a church with a casino attached, and right now, the casino is getting crowded. He's clearly talking about the rise of speculation, things like zero-day options, short-term trading, all that high-velocity activity that looks like investing on the surface but is really just gambling, and he doesn't sugarcoat it. He straight-up calls it gambling, and I think he's right. If you look at how people trade today, especially with the influence of social media and instant access platforms, a lot of it is driven by emotion, not fundamentals. People aren't asking what something is worth. They're asking how fast it can go up. That's a completely different mindset. But what's interesting is that Buffett doesn't say this means investing is dead. He just says prices can get silly. That's an important distinction, because when prices get disconnected from reality, that's actually where long-term opportunities are born. It just requires patience to wait for the correction. Then he gets into something that I think is one of the most valuable parts of the entire interview. He talks about when the best opportunities actually show up. And his answer is simple: when nobody else is picking up the phone. That's such a powerful image. When markets are crashing, when fear is everywhere, when liquidity dries up, that's when real investors step in. And he even takes it further by saying that during those moments, the market structure itself can work against you. Wide spreads, unreliable pricing, information asymmetry, it becomes brutal. And this is where I'll add my own take. Most people think they'll be brave when the market crashes, but when it actually happens, it feels completely different. It feels like the world is ending. That's why so few people actually capitalize on those moments. Buffett isn't just talking about strategy here, he's talking about psychology. Then the interviewer tries to get him to predict where the next crisis might come from, and Buffett basically shuts that down. He says if you could see it coming, it wouldn't happen, and that's such a key insight. He even references the assassination of Archduke Franz Ferdinand as an example of how unexpected events can reshape the world. That's his way of saying the biggest risks are the ones nobody is talking about. But what I like is that he doesn't dwell in fear. He makes it clear that worrying about these things doesn't help. Be aware, yes, but don't let it paralyze you. That balance between awareness and calm is something most investors struggle with. Then the conversation moves into inflation, and Buffett gets very real here. He basically says if inflation runs out of control, there's not much you can do except avoid being destroyed by it. He references historical cases like Weimar hyperinflation to show how damaging it can be, and this is where I think his perspective is incredibly valuable. A lot of newer investors have only experienced relatively stable inflation environments. Buffett has seen what happens when confidence in a currency breaks down. And his message is clear: when people lose faith in money, everything changes. He also touches on the role of central bankers, like Jerome Powell, and even references Paul Volcker. And while he expresses confidence in leadership, he also admits something important. Economists don't always see the biggest shifts coming. He even mentions Paul Samuelson and how major developments like zero interest rates weren't even considered in earlier models. That's a reminder that no system is perfect. No model captures everything. And again, it comes back to humility. Then we get into leadership and CEOs, and I found this part really interesting. Buffett talks about how even great businesses can survive bad decisions for a long time, especially if they have strong underlying demand. He praises Tim Cook, which isn't surprising, but what stands out is how he frames management. He says most managers are good at handling small problems, but it's the big, unpredictable challenges that define outcomes, and that's where top leadership matters. He also makes a pretty funny but insightful comparison to marriage when talking about judging people. Basically saying, even with years of experience, humans are still not great at predicting how relationships will turn out. And if we struggle with that, imagine how hard it is to evaluate executives. Then the conversation shifts into AI and deepfakes, and you can tell this is something that genuinely concerns him. He brings up scenarios where highly realistic fake content could manipulate people at scale. And honestly, this is one of those areas where I think Buffett's caution is justified. We're entering a world where seeing is no longer believing, and when trust erodes, especially in leadership or information, the consequences can be massive. This isn't just a tech issue, it's a societal issue. Toward the end, he talks about succession and why he chose Greg Abel. And what's interesting is, he emphasizes intelligence and business understanding over personality. He even jokes that he didn't pick him because he's a nice guy. That tells you something important. In high-stakes environments, competence comes first. Character matters, but ability is non-negotiable. Then he zooms out to talk about America itself. And regardless of where you stand on that topic, you can see how much he believes in the system. He calls it a miracle, while also acknowledging its flaws, especially inequality, and I think that's a fair take. You can recognize the strengths of a system while still seeing where it falls short. That kind of balanced thinking is something we don't see enough of today. Finally, he closes with something simple but powerful: the golden rule. Treat others the way you want to be treated. And he frames it not just as a moral idea, but as a practical one. It actually benefits you in the long run. And I'll be honest, that might be the most underrated takeaway from the entire interview. In a world obsessed with strategies, tactics, and edge, sometimes the simplest principles are the ones that endure. So when you step back and look at this entire conversation, it's not really about stock picks or market predictions. It's about discipline, patience, humility, and character. Buffett isn't trying to impress you with complexity. He's reminding you that long-term success is built on simple ideas executed consistently. And with that perspective in mind, now let's dive in and talk about the two undervalued growth stocks that could still have massive upside even as the market gets noisier, more speculative, and harder to navigate. The first company is Carnival Corporation, ticker symbol CCL. Now before we even touch valuation, you need to understand the underlying machine here. Carnival is not just a cruise company, it is a global tourism platform. It owns multiple cruise brands, operates a massive fleet, and serves millions of customers across different income levels and geographies. That diversification is part of its moat. What makes Carnival powerful is the experience economy. People are spending less on things and more on experiences. Travel, entertainment, and lifestyle have become a bigger priority, and cruises sit in a unique position because they bundle multiple services into one. Transportation, hotels, dining, entertainment, all integrated into a single purchase. That creates pricing flexibility and value perception that traditional travel providers struggle to match. Now here's where the story gets interesting. Carnival is back in focus after reporting strong Q1 2026 results with record bookings. That is not just a recovery signal, that is a growth signal. It means demand is not only back to pre-disruption levels, it is pushing into new territory. But at the same time, the company trimmed its full-year adjusted earnings outlook. And the reason is simple: fuel costs. This is where a lot of investors get tripped up. They see earnings guidance come down and assume the business is weakening. But in reality, you have to separate temporary cost pressure from structural demand strength. And right now, demand is strong. The stock is currently trading around $26.66. Over the past 90 days, it has declined about 11.19%. That short-term weakness creates doubt. But zoom out. Over 1 year, total shareholder return is about 36.86%. Over 3 years, it is roughly 17 times. That tells you the market has been steadily re-rating this business as conditions improve. So what you are seeing right now is not a broken story. It is a pullback within a larger recovery trend. Now let's talk about valuation, because this is where things get compelling. There is a widely followed narrative that places Carnival's fair value around $37.70. Compared to the current price of $26.66, that suggests roughly 29.3% upside. That is significant. It implies the market is not fully pricing in the company's future earnings potential. Analysts have a consensus price target around $33.09. But the range tells a deeper story. The most bullish view is $43, the most bearish is $24. That spread reflects uncertainty, and uncertainty creates opportunity. Now let's break down what needs to happen for that upside to play out. First, revenue needs to remain strong. With record bookings, Carnival has visibility into future demand. That is a huge advantage. It allows the company to plan capacity, pricing, and operations with more confidence. Second, margins need to improve. As the company continues to optimize operations, reduce inefficiencies, and scale its fleet utilization, profitability can expand. Third, the market needs to maintain a reasonable multiple. The valuation assumptions behind that $37 fair value do not require extreme optimism. They rely on steady execution. Now here is where I want to go deeper. Carnival also benefits from something many investors overlook: operating leverage. This is a business with high fixed costs, ships, maintenance, staffing. But once those costs are covered, additional revenue flows through at a higher margin. So when bookings increase, the impact on earnings can be amplified. That is where the upside comes from. But you cannot ignore the risks. Fuel costs are a major variable. If they stay elevated, they can compress margins. Then there is the balance sheet. Carnival took on significant debt during the pandemic. That debt needs to be managed, refinanced, and gradually reduced. If interest rates remain high, that could put pressure on earnings. So you have a classic setup: strong demand, improving operations, but real financial risks. Now here is how I look at it. The market is focusing heavily on the risks: fuel costs, debt, short-term earnings pressure, but it may not be fully appreciating the strength of demand and the potential for long-term cash flow growth, and that is where mispricing can happen. If Carnival continues to execute even moderately well, the current valuation could look very attractive over time, and this is where investor psychology comes into play. Most people want certainty. They want clear signals that everything is perfect before they invest. But by the time everything looks perfect, the stock is usually already expensive. Right now, Carnival is in that middle phase. Not perfect, not broken, just misunderstood. And those are often the best opportunities. Let me add one more layer to this. Carnival has been going through operational updates and structural changes, including the unification of its dual-listed company structure. These kinds of moves can improve efficiency, simplify reporting, and enhance investor confidence over time. These are not headline-grabbing changes, but they matter, because they shape how the business performs over the long run. So when you combine record bookings, operational improvements, and a valuation that suggests upside, you start to see why this stock is getting attention again. But again, this is not a guaranteed win. If fuel costs spike further or macro conditions weaken, the stock could face more pressure. So this comes down to your conviction. Do you believe in the long-term growth of the experience economy and Carnival's position within it? Because if you do, this could be a compelling entry point. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Now let's move on to the second stock, and this one plays in a completely different arena. The company is Cenovus Energy Inc., ticker symbol CVE. This is an integrated energy business that operates across production, refining, and marketing. That integration is critical. It allows the company to capture value at multiple stages of the energy supply chain, and here is why this matters. Energy is not optional. It is essential. Every economy depends on it. Every industry relies on it. And despite the global push toward cleaner energy, oil and gas remain a foundational part of the system. Cenovus is positioned right in the middle of that system. Now let's address the elephant in the room. This stock has already had a massive run. Over the past 7 days, it is up 9.9%. Over 30 days, up 7.6%. Year to date, up 65.2%. Over 1 year, up 147.6%. Over 5 years, up 362.1%. Those numbers are huge, so the natural question is it too late? And this is where things get really interesting. Despite that performance, the stock still appears undervalued based on multiple valuation methods. Let's start with the discounted cash flow analysis. Cenovus generated about 3.7 billion Canadian dollars in free cash flow over the last 12 months. Analysts expect that to grow to about 5.2 billion by 2027. Beyond that, projections extend to 2035, with annual free cash flow estimates ranging from 3.5 billion to 6.9 billion. When those cash flows are discounted back to today, the estimated intrinsic value comes out to around $82.31 per share. Compare that to the current price of about $39.74. That suggests the stock could be undervalued by about 51.7%. That is a massive gap. Now let's look at another angle. The PE ratio. Cenovus is trading at about 19.07 times earnings. The industry average is around 21.94, and the peer group average is about 23.89. There is also a fair ratio estimate of about 20.32 times. So even on a relative basis, the stock appears undervalued. But here is where you need to go deeper. Valuation alone is not enough. You need to understand what drives those numbers. Cenovus is a cash flow machine. It generates billions in free cash flow and has the ability to return that cash to shareholders. That can come in the form of dividends, share buybacks, or reinvestment into the business. And this is where the long-term story becomes compelling. Even if revenue declines slightly, around 6.1% annually as some projections suggest, the company can still grow earnings through margin improvement and operational efficiency. Some estimates see earnings reaching around 4.7 billion by 2029. That growth does not rely on explosive revenue expansion, it relies on disciplined execution. And in the energy sector, that matters a lot. Now let's talk about capital allocation. This is one of the most important factors for any energy company. Cenovus operates in a capital-intensive industry. It requires continuous investment to maintain production and expand capacity. So management decisions around spending, debt, and shareholder returns are critical. If capital is allocated efficiently, the company can generate strong returns even in a volatile price environment. If not, value can be destroyed quickly. Now let's address the risks. Energy prices are unpredictable. Regulation is always evolving. The global shift toward cleaner energy creates long-term uncertainty, and funding conditions can impact the company's ability to invest and grow. So this is not a simple buy-and-forget stock. But here is the key insight. Even after a massive rally, the market may still be underestimating the company's long-term cash generation. That is rare. Usually after a stock runs this much, it becomes overvalued. But in this case, multiple valuation methods still suggest upside, and that is what makes it interesting. This is not a story about hype or speculation. It is a story about cash flow, discipline, and positioning within a critical industry. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. So now the question becomes, which of these two opportunities stands out to you more? Is it Carnival, with its recovery-driven growth and leverage to global travel demand, or is it Cenovus, with its strong cash flow profile and position in the energy market? If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Let me know your thoughts in the comments. Which business do you believe has the stronger long-term advantage, and why? Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.